You have a full-time job, but you're also doing freelance work on the side, or driving for a rideshare app, or selling on Etsy, or running a small business from your home. As a new permanent resident in Canada, any money you earn outside your T4 employment income comes with a completely different set of tax rules. Rules that most new PRs don't know about until they get hit with a surprise CRA bill. In the next 8 minutes, I'm going to walk you through everything you need to know about side hustle and self-employment taxes in Canada so you never get caught off guard. Let's go. Here's why this hits new PRs particularly hard. Many new permanent residents arrive with strong professional skills and start freelancing in their field while searching for full-time employment. Others join the gig economy, driving for Uber or Lyft, delivering for DoorDash or SkipTheDishes, or doing task work on apps like TaskRabbit. Others sell products online through Etsy, eBay, or Amazon. All of these generate self-employment income. And here's the critical difference from your regular T4 job. Your employer withholds income tax from your paycheck automatically. Nobody does that for self-employment income. You receive the full amount, and you are completely responsible for setting aside your tax, your CPP contributions, and potentially your GST, HST. New PRs who don't know this routinely spend all their side income, and then face a large, unexpected tax bill the following April. Before we get into the tax rules, you need to understand how the CRA draws the line between a hobby and a business. The CRA considers your activity a business when you have a reasonable expectation of profit, you operate in a business-like manner by advertising or invoicing, or you earn income through any gig platform. The moment you earn money through Uber, DoorDash, Airbnb, Etsy, Fiverr, or any similar platform, the CRA automatically treats it as business income, regardless of the amount. There is no minimum threshold for reporting self-employment income. Even $50 earned from a freelance project must be declared on your tax return. The $30,000 threshold only applies to GST, HST registration, not income reporting. Every dollar counts. Self-employment income in Canada is taxed in 3 layers. Layer 1 is income tax. Your net self-employment income, revenue minus allowable expenses, gets added to your other income and taxed at your marginal rate. If you earn $70,000 from your T4 job and $20,000 net from freelancing, the CRA treats your total income as $90,000 and taxes accordingly. Layer 2 is CPP contributions, and this is the one that shocks new PRs the most. As a self-employed person, you pay both the employee and employer portions of CPP. In 2026, that's 11.9% on net earnings between $3,500 and $71,300. On $20,000 of net self-employment income, your CPP bill alone is nearly $2,000. Layer 3 is GST, HST, which we'll cover in a moment. The bottom line: set aside 25 to 35% of every dollar of self-employment income you receive. Do it immediately when the money hits your account, not at tax time. Now, here's the good news: you can deduct legitimate business expenses from your revenue before calculating tax. Fully deductible expenses include professional fees, software subscriptions you use for your work, equipment you purchase for the business, marketing costs, professional development, and business insurance. Partially deductible expenses include your home office. A proportional share of your rent, utilities, and internet qualifies. Your vehicle costs are deductible in proportion to business kilometers. Meals with clients are 50% deductible. All of these are reported on Form T2125. Keep every receipt for at least 6 years. A well-managed self-employment deduction strategy can reduce your net income significantly and lower your total tax bill by thousands. Let me zoom in on the CPP double contribution because this is the #1 surprise tax bill for new PRs running a side hustle. When you work a T4 job, your employer pays half your CPP. You each contribute 5.95%. When you're self-employed, there is no employer. So you pay both halves, 11.9% total. On $20,000 of net self-employment income, that's nearly $2,000 in CPP contributions alone, on top of your income tax. The silver lining: every dollar of CPP you contribute builds your CPP retirement benefit. And if your T4 job already maxed out your annual CPP contributions, you may owe little or no additional CPP on your side income. Check your CRA My account before tax season. GST and HST. Once your self-employment revenue crosses $30,000 in any rolling 12-month period, you must register for a GST, HST number, charge it on every invoice, and remit it to the CRA. There are two important exceptions. If you drive for Uber, Lyft, or any rideshare platform, you must register from your very first dollar, no threshold. Same rule for food delivery platforms. Once registered, you add GST or HST to every invoice, collect it from clients, and remit it quarterly or annually. But you also get to claim back the GST, HST you paid on your own business purchases, input tax credits. In practice, you remit the difference between what you collected and what you paid. When your expected tax bill exceeds $3,000, the CRA requires quarterly installment payments. The dates are March 15th, June 15th, September 15th, and December 15th. If you miss them, CRA charges interest at around 8% per year. The most practical system: open a separate EQ Bank savings account specifically for your tax money. Every time a self-employment payment arrives, immediately transfer 30% into the tax account. Don't touch it until installment time. This one habit eliminates the biggest financial stress of self-employment. Here's how to file. Track every dollar of self-employment revenue and every business expense throughout the year using Wave. It's free. At tax time, complete Form T2125 inside Wealthsimple Tax or TurboTax Self-Employed. Enter your gross revenue and allowable expenses. T2125 calculates your net income, which flows onto your T1 return. CPP is calculated on Schedule 8 automatically. If GST, HST registered, file a separate GST, HST return through CRA My Business account. The self-employed filing deadline is June 15th. But your balance owing is still due April 30th. A question many new PRs ask is, should I incorporate? Start as a sole proprietor. It costs nothing, requires no separate tax return, and is appropriate for the vast majority of side hustles. All income flows onto your T1 at your marginal rate. Incorporate when your self-employment income consistently exceeds $100,000 to $150,000 per year and you're not withdrawing all of it. The small business deduction means an incorporated Canadian business pays only 9% federal corporate tax on the first $500,000 of active income. But incorporating adds real complexity. A corporate tax return costs $2,000 to $5,000 annually with an accountant. Most new PRs should stay sole proprietor until net self-employment income is consistently above 6 figures. Here's the summary. Report all self-employment income from $1. Set aside 25 to 35% of every payment. You pay both employee and employer CPP at 11.9%. Rideshare and food delivery drivers register for GST, HST immediately. Track every business expense on Form T2125. They reduce your tax bill. Make quarterly installments if your bill exceeds $3,000. Self-employment is one of the most powerful wealth-building tools for new PRs in Canada, but only if you know the rules from day one. If this gave you clarity on side hustle and self-employment taxes in Canada, hit like and subscribe to PR Wealth Lab. Comment below. What's your side hustle? Are you already tracking your income and setting aside tax?